Employee ownership suggests a company that is either wholly or majority owned by or on behalf of its employees. So that could include significant ownership, which may be down to as little as 25%, but often it means majority ownership, where the employees or a trust on behalf of the employees own more than 50% of the shares in the company. One of the best known employee-owned companies in the UK is John Lewis, which is 100% owned by an employee trust. There's actually a strong range of evidence which shows that employee-owned companies tend to be more successful in a number of ways. One of those is that they are often more productive. There's also some evidence showing that in harder times, including the most recent recession, employee-owned companies have been shown to be more resilient. Now, if you're an owner that's thinking of retiring, you may be attracted to employee ownership because you may see it as a more attractive form of future ownership for your company compared with the alternative of selling to a third party. You may also be interested in the fact that there are some new tax reliefs which mean that you can potentially avoid paying any capital gains tax on the sale of your company to an employee trust. There are also some income tax advantages for employees if your company is controlled by an employee ownership trust. Employee ownership can take three main forms. So the first of those is to have employees owning shares individually, and they'll have their own share certificate showing a personal ownership stake in the company. An alternative, and probably one that's simpler to operate but not necessarily right for every company, is not to have any individual share ownership but to have all the ownership held on behalf of employees through an employee trust, and that's often called the John Lewis model. The third possibility is to have a combination of the two. So you could have some individual share ownership but always retain a block of shares permanently held in a trust on behalf of the employees. Yes, there are now two tax breaks. So the first of those is aimed at company owners wishing to retire. So if you're a company owner and you sell a controlling interest, in other words, more than 50% of your company to an employee ownership trust, then you will be entirely free of capital gains tax on your sale proceeds. So that's great news if you're a company owner, but what about anybody else? Employees, for example. Well, if you're an employee of a company that becomes employee-owned through an employee ownership trust, again, if the trust has a controlling interest, more than 50%, then the company can pay you an annual bonus free of income tax. Now, there is a financial limit on that, which means that the maximum annual bonus you can be paid is £3,600. But for many employees, the ability to be able to be paid £3,600 completely free of income tax can actually be quite significant. Well, the tax breaks are certainly designed to encourage more companies to become employee-owned, and we think it's very likely that they will achieve that objective. I wouldn't say that any company should become employee-owned purely because of the tax breaks, so you always need to make sure that it's going to be the right thing in your own company. That said, if you decide it is right for your company, then the existence of the tax breaks may be something that tips the balance in its favour.